Hello, welcome to the second part of this chapter. Just wanted to let you know I'm Dr. Sharma and I'm a professor at Elizabeth City State University and also the chair of the department currently. I've authored several books on accounting and published research papers, and I'm a member to all these professional organizations. If you want to learn more about me, you can visit on this website. Now let's start our second part. Now the second part of this presentation deals with introduction to accounting and business part 2. We already took 3 learning outcomes. Now we are going to cover the rest of the learning outcomes. Those are very critical to this chapter. Now, as I said to you, we already covered the 3 first learning outcomes. Now we'll be covering the 4 and the 5th. The 4th one deals with use of accounting equation to study the impact of business transaction on the elements of accounting equation, and the 5th will introduce the financial statements of a corporate, and of course it will also talk about their interrelationship. So let's get into learning outcome number 4. We'll use the accounting equation to kind of explain the impact of business transaction on the elements. So now, of course, business transactions and events impact the accounting equation. And first, we need to know what is a transaction. Now, transaction is an exchange of value between 2 or more parties, or an event that has a financial implication, are combinedly called as business transaction. So one is a transaction, another is an event having a financial implication. So when does a transaction take place? If I sell goods or provide services to a customer, there is a transaction. But what is an event? An example of an event would be a loss of goods by fire. So there is no transaction, but an event has taken place which has a financial implication. And we call them as a transaction. So when we refer to the business transaction, we refer to them both the transaction and the event. Some people classify transactions as external and internal, meaning transactions as external transaction and events as I described as internal transactions. So you will also see that kind of nomenclature. However, the bottom line is all business transactions can be stated in terms of changes in the elements of accounting equation. So all transactions and events will have an impact on the elements of accounting equation. We have talked about that accounting equation as asset being equal to liabilities plus the stockholders' equity. So this accounting equation, there are 2 or 3 things that you have to remember about accounting equation. It is an equation. It means it has to remain equal at all points of time. And any change in one element will impact either the change in the same box or it could be a different one. Like supposing an asset could go up and asset could come down, or a liability would go up or a liability would come down, and the asset will also be impacted. In this transaction, supposing this is the first transaction, on January 1st, 2020, John Smith deposited 50,000 in a bank account in the name of Kitty Supplies in exchange for shares of common stock in the corporation. So Kitty Supplies is the corporation and John Smith is the owner. So probably this would be a LLC. Now he has deposited 50,000 in the bank in the name of the business. So one thing you have to get it very clear in the beginning, all these transactions will be looking from the perspective of Kitty Supplies, not John Smith. So for the Kitty Supplies Corporation, cash has gone up. So that's why this is a plus 50,000. And in return, we are giving John Smith 50,000 common stock. So common stock as well is increased. Right now we didn't issue any common stock. First thing we are issuing it, so therefore it has gone up. So your accounting equation is 50,000 equal to 50,000. So now, what is a common stock? Of course, there are two kinds of stock, a common stock and a preferred stock. Corporation issues this stock to investors as a proof of their ownership rights. Now, common stock has a ownership and a voting right. Now, preferred stock may not have the voting right. So normally they have preference over return of capital and preference over dividend, but may not have a voting right. So this is transaction number one. So after transaction A, our balance is 50,000 in assets and 50,000 in stockholders' equity. Let's say on January 5th, 2020, Kitty Supplies paid 40,000 for the purchase of land as a future building site. So what has happened is the 40,000 has been taken out of cash and put into another asset as a land, but still your balance remains as 50,000 and 50,000 because the cash has been reduced to 10,000 and we have created a new account land and that has a balance of 40,000. So therefore it balances out as 50,000. So that is how transactions impact the accounting equation. We'll see other examples as well. On January 10, 2020, Kitty Supplies purchased supplies for 2,000 and agreed to pay the supplier in 30 days. So we purchase supplies. Now they remain as an asset until I have used up the supplies. So that's why I have created a column for supplies and 2,000 there. And since I did not pay for the supplies, now I won't be using anything in the cash column. Rather, I'll be creating a liability account known as accounts payable. Accounts payable will go up when you incur the liability and it will come down when you pay that liability. Right now, I'm incurring the liability, so it has gone up. And if you look at the accounting equation ultimate balance, it comes out to be 52,000. And this side also you see a liability plus stockholders account is also 52,000. So the accounting equations are balanced. Now the liability created by a purchase on account is called accounts payable. Items such as supplies that will be used in the business in the future are prepaid expenses, which are assets. So therefore I'm going to use that as an asset supplies. So that is your transaction number C. Number D, when a business sells goods or provides services to its customers, it earns revenue. Now the revenue will increase the stockholders' equity. That's why, as we saw in the accounting equation, we'll be showing that as an addition to stockholders' equity in the accounting equation. In the same vein, all expenses will reduce the stockholders' equity. So we'll be showing them as a deduction from the stockholders' equity in the accounting equation. We'll see that in future transactions. On January 18, 2020, Kitty Supplies received cash of 15,000 for providing services to a customer. Now this is a cash revenue. Therefore, cash has gone up by 15,000. Earlier we had a balance of 10,000. Now our new balance of cash is 25. No change in supply, so this is 2,000. No change in land, it still remains at 40. So the total adds up to 67. And on the other side, as I said to you, stockholders' equity gets increased with the revenue. That's the fees earned here. So plus 15,000. So it had a common stock of 50,000 plus 15 plus 2,000 will be 67,000. So that's how accounting equation is remaining balanced. So now the general concepts of revenue, because it's an important element and people get confused about it. So that's why I'm taking time to discuss about it. First, revenues from providing services is always recorded as either a service revenue or a fees earned. Now that nomenclature becomes important because you want to know what is the source of the revenue. Revenue from the sale of merchandise is recorded as a sales revenue or simply as sales. So that is another nomenclature. We normally refer it as a sales, or it is important that you write sales revenue so that you keep tab of what kind of account is that. Any other source of revenue will be suffixed with revenue. Like if it is a rent, you are receiving it as a revenue, you will call it as a rent revenue. If you're receiving interest as a revenue, we call it as interest revenue. Dividend as dividend revenue. Whenever sales or service revenue is accrued and accounts receivable is accrued, means I have provided the revenue, provided the service or sold the products but have not received cash, so then it is an accrued amount. I have done my part but the customer is yet to pay me. I'll create an account receivable as a claim against the customer, which is an asset, of course. In other cases, receivable words is suffixed with the revenue. If it is a rent revenue receivable, it will be a rent receivable. If it is an interest, it will be interest receivable and dividend. If you receive cash, then we'll consider cash. If you have not received in cash, you'll be considering that as a receivable. Now, let's go on to the expenses. During the month, Kitty Supplies spent cash or used assets in earning revenue. Assets that are used in this process of earning revenue are called expenses. These expenses ultimately would reduce the stockholders or the shareholders or owner's equity. That's why these are shown as deduction in the accounting equation. So if you look at on January 30, 2020, Kitty Supplies paid the following expenses: wages, rent, utilities, and miscellaneous. So these all expenses add up to 7,300. That's 4,250 plus 16 plus 900 plus 550. And these are reductions in the stockholders' equity. So that's why these are shown as deductions minus amounts. And if you add up the left hand side, you will come up with a total of 59,700, and the right hand side also will come up to 59,700. So the accounting equation remains balanced at that amount. Now we have another transaction on January 30, 2020. Kitty Supplies paid creditors on account. Paid creditors on account means I'm paying off the liability. I had accounts payable of 2,000. I'm paying 1,900. So therefore it reduces cash. So I'm reducing my cash, and also I'm reducing the accounts payable. That way again my accounting equation changes. On the left hand side it becomes 57,800, and the right hand side becomes also 57,800. So that's how we'll handle this transaction. So when you're paying accounts payable, now of course it will get reduced, because if you don't, it will show that I owe 2,000. So that's not a good reporting feature even when you have paid it. All right, so now our next transaction is on January 30, 2020. John Smith determined that the cost of supplies on hand at the end of the month was 1,100. So remember, we had 2,000 worth of supplies. Now the owner has determined it is only 1,100. So what does that mean? It means 900 worth of supplies must have been used during the month. So the used supplies is in supply expense. So I'm going to take it out from supplies and put it in the supply expense account. Now again, as an expense, it is a minus from the stockholders' equity. So that's why I'm showing that as a minus 900 there. Now, so basically what is happening is I'm using up my supplies and a new account is being created. Now 56,900 on the left hand side and 56,900 on the right hand side. So that remains balanced as such. Now on January 30, 2020, a dividends of 4,000 were paid. Now, as you know, dividends are not expenses, they are distributions of earnings to the stockholders. Hence, the stockholders' equity will be reduced. So that's why you can see that as a minus 4,000. And then, of course, cash is being paid out to the owner, so cash is getting reduced. Again, remember, we'll have to always look from the perspective of the business. Now, after we have done everything, this is the summary. At the end of the month, I have 11,800 in cash, 1,100 in supplies, 40,000 in land, 100 in accounts payable. Common stock is 50,000, dividends 4,000, fees earned is 15,000, and expenses of 4,000, 250, 16, 900, 900, and 550. All add up to 52,900. So that's the summary of the transaction that we have taken. Now you will notice that the effect of each transaction is either an increase or decrease in one or more of the elements of accounting equation. And the two sides of accounting equations have always been equal. So that is something that you have to really keep in mind. Now we go on to little detail about the components of stockholders' equity. There are basically two components of stockholders' equity, which are common stock and retained earnings. They are reported separately to track the contributions of each of them. Some companies may issue preferred stock, which will be shown as part of the stockholders' equity. So in a stockholders' equity component, you will be having the common stock and maybe sometimes preferred stock, and the next would be the retained earnings. Retained earnings is the part of the stockholders' equity which is retained in the business after dividends have been paid out. Common stock represents the portion that has been contributed by the investor. So, stockholders' equity transactions, you will have any investment made by the owner will be either a common stock or a preferred stock, plus the net income minus whatever is the dividend. So that will be the end amount in the stockholders' equity. Okay, now let's just take an example of a business transaction and the accounting equation. Home Kitchen is a local takeout delivery operating in Richmond, Virginia. At the beginning of the month, March 1st, Home Kitchen has the following account balances. So it's an existing business. You have a cash balance 65, accounts receivable 10,000, payable is 5,000, common stock 65, service revenue 10,000, wages 5,000. The following selected transactions were completed by the company. So received cash from the owner as additional investment. Like we learned in the previous one, we had a cash of 65, so I'm getting 40,000 more cash. So that's how I'll be accounting that aspect. So if you look at that one, that's what is happening. So let's read all that and then we'll take that one by one. Paid creditors on account. So you can see accounts payable are 5,000. I'm paying 4,000. So that will be use of cash and reduction in accounts payable. So receive cash from customers on account. So that's 10,000. Bill customers home meal services on account. That's a revenue 36,000. Wages expense, utilities expense, and paid dividends 9,000. Now you prepare a table to indicate so the effect of these transactions. So I've shown the effect of the transactions. The first one is, now as you can see, looking at all the accounts that are given to you, I've fit them in a table with two assets, one liability, and several items of stockholders' equity. The first transaction, what we'll do is we'll put the balances that were given to us. 65,000 in cash, 10,000 in accounts receivable, 5,000 in accounts receivable. Common stock was 65,000, service revenue was 10,000, and wages was minus, of course, 5,000. Since it reduces the stockholders' equity, we're taking that as minus. In the first transaction, we received another 40,000 in cash for common stock. So you can see these two accounts are affected. And then in the second one, we paid off 4,000 of the accounts payable. So you can see cash is reduced and accounts payable is reduced. And then what we did was we got that 10,000 from the customers. So customers paid that 10,000 cash. So cash is going up by 10,000. Accounts receivable is going down by 10,000 because we received the amount. So therefore, their account needs to be reduced as they pay. And we got a service revenue providing meals of 36,000. And since we did not receive them in cash, we are going to put that in the accounts receivable bucket, and a service revenue of 30,000. And then we paid wages of 20,000 in cash, so cash is going down, and wages is of course will reduce the stockholders equity. And then cash is going down with 6,000 because of utilities expense paid. And then cash is going down because of dividends that we have paid. So therefore, you have a final balance of 76,000 in cash, 36,000 in your accounts receivable, total working out to be 112. And accounts payable, we are left with 1,000, common stock 105, dividend is 9,000, 46,000, 25,000, and 6,000. So that's how we have to understand about the effect of each of the transactions on the accounting equation. Now we have completed learning outcome number 4. We are going to talk about learning outcome number 5. It basically introduces the financial statements, learning objective number 5. It introduces the financial statements of the corporation. So as an outcome, learning outcome, students will be able to prepare the 3 basic financial statements after covering this segment of the chapter. Now, after transactions have been recorded and summarized, general purpose financial reports are prepared for users, which are commonly called financial statements. The primary financial statements of a corporation are income statement, retained earnings statement, balance sheet, and a statement of cash flows. In between, we prepare a comprehensive income statement as well. But these are the 4 common required financial statements. Now, the order in which we prepare the financial statements are: first, we need to prepare the income statement, which summarizes the revenue and expenses for the period. Second, we'll prepare the retained earnings, and the retained earnings summarizes the changes in the retained earnings for a period. It will increase with the net income, decrease with the dividend, and we'll calculate a new balance in that account. Then we prepare the balance sheet, because I'll have to bring down that summarized what you call retained earnings balance to add up to the stockholders equity. So summarize the assets, liability, and stockholders equity on a specific date or a point of time. So balance sheet is a point of time statement. The rest of the 3 are a periodic statement which cover a period. Summarizes cash from operating, investing, and financing activities for a period. That's the statement of cash flows. We'll not be talking about the statement of cash flows in this chapter, because we'll be dealing that as a separate chapter in our course. So that is why we'll not be dealing statement of cash flows as such in this chapter. Now you can see we had kind of populated all the information for kitty supplies. So if you look at these kitty supplies at the final, we had fees earned of 15,000 and all these expenses, and a dividend of 4,000, cash of 11,800, supplies of 1,100, and land is 40,000. So using that information, what we can do is we can prepare the income statement. So kitty supplies income statement for the period ended 31st of January 2020. Now, as you can see in the balance sheet, I'm saying 31st December 2020. So 31st January 2020, because it's a specific date statement. These are periodic ones. So revenue was 15,000. We had expenses. Now it is organized in a descending order. The highest expenses put first, and the miscellaneous expenses always the last, irrespective of the amount. Then we add a total, and this minus this will give you a net income. Revenue minus expense will give you a net income of 6,800. That 6,800, we bring it down to retained earnings statement. Now, retained earnings didn't have a balance, so we had a dividend of 4,000. So then we had a net change in retained earnings of 2,800. 0 plus 2,800 will give you again 2,800 as the ending balance for retained earnings. Then we take it to the balance sheet. As you can see, this is the interlink. If you make a mistake in calculating the net income, you'll get a wrong retained earnings amount, and you'll get a wrong stockholders equity in the balance sheet as well. So everything will go topsy-turvy. So you'll have to be very careful about the income statement. So in here we have assets and we have a liability. There was only one liability, and I said two elements of stockholders normally two. The common stock and retained earnings, it could be three with the preferred stock. So that is how we prepare the financial statements from those elements of accounting equation table that we completed. So as you can see, income statement reports the revenues and expense for the period. The revenue and expense recognition principles are used to ensure that the match the revenues and their related expense so that they are reported in the same period. So if you have a revenue for January, you should be comparing the expenses of January with that revenue to calculate the correct amount of net income for January. Excess of revenue over the expense is called net income or net profit or net earnings. The deficit arising with the expenses exceeding the revenue is called a net loss. So that is about the income statement. The retained earnings statement, of course, reports the changes in the retained earnings for a period, and the statement is prepared after the income statement, as I said to you, since we use the net income or net loss for the period to bring it down to the statement and report it here. Similarly, it is prepared before the balance sheet because the amount of retained earnings balance at the end is to be reported in the balance sheet. So that is why it's prepared before balance sheet but after income statement. Now, a balance sheet reports the amounts of assets, liabilities, and stockholders' equity as of a specific date. So a report form presents a balance sheet in a vertical form. Sometimes we also do a T-shaped one. So one side we put it on the left hand side and the other as on the right hand side. So, but we normally use a report format. And then the last financial statement we'll be talking about is the statement of cash flows. It consists of three following sections. Operating activities, these are the backbone activities of any organization. So all activities that are carried on a day-to-day basis are called as the operating. And if you don't have positive operating activities, then it will impact the other activities. Investing is, as the name suggests, in what areas are you investing your money, buying your long-term assets for future use. And financing is how are you using your finances, who is providing the finance. Are you borrowing or are the owners giving you the money, or how much money you're paying them back as dividend. So that would be your financing activities. So those are the three activities. So cash flows from operating activities will report the summary cash receipts and cash payments from operation. Cash flows from investing will report the transactions to acquire or sell a relatively permanent asset. If it is a current asset, it will be part of operating activities. If it is a long-term one, then it is an investing activity. Cash flows from financing activity will report cash transactions relating to any investment made by the stockholders, borrowing, or any sort of dividend. So, supposing, let's see, we are given this information. Sunita Travel Service assets and liabilities as at December 31st, 2020, and its revenues and expenses for the given are given as follows. So we have accounts payable, that's a liability, accounts receivable and asset, cash as an asset, common stock is a part of stockholders, fees earned is a revenue, land is an asset, miscellaneous expenses an expense, office is also an expense. Supply is an asset. Wage expense is an expense. Now, Sunita Travels had retained earnings of 60,000, so that's the opening balance of that. During the year, dividends of 40,000 were paid. So, apart from this information, that's the additional one. So, we prepare the income statement. Of course, as I said to you, we'll be always starting with the revenue. We have a 525,000 revenue and a bunch of expenses. We'll take them to income statement. Then we prepare the retained earnings, start with that 60,000. Whatever net income we got from income statement will be added, and you will adjust that 40,000 of dividend. And then we'll prepare the financial, last financial statement, balance sheet. The will be then showing the interrelationship of this financial statement. So as you can see, what we have done is we have taken the fees earned here, 525,000, and all expenses here, and then calculated a net income of 110,000. Now remember, retained earnings, we had 60,000 balance, we are taking the 10,000, 110,000 there, and the net change is 70,000, positive 110, negative 40,000. So that's 70 plus 60 will be 130,000. That we bring it down here. So cash balance 106, accounts receivable 62, 7,000 supplies, land 180, and the total was 355,000. Accounts payable 25,000. Common stock balance of 200 plus 130 will make it 330, plus 25 will be 355. So this is how we prepare the three financial statements. And that brings to an end of this presentation. Thank you very much. I'll pick up the rest of the course material for this chapter in the next video.